What's up? This is Ryan with Planet Cheapskate. In this video, we're going to be discussing everything you need to know when it comes to your home loan mortgage payment. We will cover how to calculate what's included in your monthly payment, what different options you have regarding your mortgage payment, and how to read your amortization schedule for your mortgage home loan. And be sure to stick around to the end of this video for 3 mortgage payment hacks that will teach you exactly what you need to know to reduce your payment to the absolute lowest amount possible. But first, I'd just like to take a very brief moment to personally invite you to subscribe and join our community. I do a home loan rate update every Friday going into the weekend, along with a new video every Thursday, helping you manage through the world of credit, real estate, and home loans. And also, when you do subscribe, be sure to hit that little bell and it will alert you whenever I release fresh content. Now, with all that out of the way, let's dive right in. So when it comes to your mortgage payment, I know things can get very, very confusing. It's very important for you to know going in exactly what's included in your monthly mortgage payment. When it comes to your mortgage payment, there are basically 5 areas you need to be aware of. These 5 areas include principal, interest, property taxes, homeowners insurance. Now, a side note here, these 4, collectively speaking, are referred to as the PITI in the industry. So then finally, the last area is your mortgage insurance. Your property tax, homeowners insurance, and mortgage insurance combined go into an account called your escrow account that the lender keeps and makes the respective payments for you whenever they come due. I'm now going to dive a bit deeper into each of these sections of your monthly mortgage payment, and if you do have any questions that come up, feel free to ask in the comments below and I will do my best to answer whatever those may be. Now, there is an option if you are putting at least 20% down or happen to have that equivalent in equity to do what's called waiving your escrows. All this means is that you will be responsible for making sure your property taxes and homeowners insurance is paid when due. Again, an escrow account is a special account the lender sets up to help you manage these payments and make them for you, so you only need to worry about one payment per month. So typically when an escrow account is utilized, your monthly payment includes your principal, which is the portion of your payment that goes towards your equity, which is sort of like your personal piggy bank of the dollar equivalent of what you own in your home. It also includes the interest portion of your payment, which is just the cost for borrowing the funds from the lender. Your monthly payment also includes an escrow account payment for homeowners insurance, property tax, and mortgage insurance. Homeowners insurance is typically paid annually, so the monthly payment is an amount equal to your annual premium divided by 12. And for property tax, the due dates are different depending on where you are located, but the escrow payment is typically the equivalent of the total due annually divided by 12, much like the homeowner's insurance. And finally, you will have mortgage insurance included in your payments. And mortgage insurance is due annually, so your payment portion is equal to your annual premium divided by 12 as well. So just to recap here, your monthly mortgage payment includes principal, interest, property taxes, homeowner's insurance, and mortgage insurance. When it comes to your monthly mortgage payment, much of the options available have to do with how much you are putting down as a down payment. So most lenders have programs that allow as little as 3%, sometimes even 0% down, but these products are not going to maximize your options when it comes to your home loan payment. In order to get the best options on your mortgage payment, you will need to put down 20%. By doing this, with most lenders, you will then unlock the potential to manage your own escrows, meaning you will be responsible for the homeowner's insurance and property tax payments when they come due. Many people prefer this because you unfortunately do not receive any interest for the funds held in your escrow account when managed by the lender on your behalf. This account can sometimes hold a very large amount of your money, and this can sometimes lead borrowers to waive their account so they can set up an account on their own and collect the interest on those funds in their account rather than the lender. Another huge benefit of putting 20% down is it eliminates the need for private mortgage insurance, as the lender now believes you have enough skin in the game that their investment is more secure from you not making your monthly payment. So most lenders eliminate mortgage insurance at 20%, but some do have programs out there that you can take advantage of that eliminate PMI sooner than 20%. Just be sure to shop around several different lenders. So the next way to affect your monthly payment and give yourself the best options involves your mortgage interest rate. So before getting pre-approved, you should make sure you have your credit cards paid down as much as possible and your credit score as high as you are able to get it, as this will help you qualify for a lower interest rate. On a $250,000 home loan, the difference in payment between 0.5% can add or subtract over $70 monthly to your payment. So this would be 3% and 3.5%, the difference would add over $70 to your monthly payment. A lower rate is huge when trying to get your best and lowest monthly payment. So next, we will pull up an amortization schedule and take a look at it together and make sure you know exactly what to look for and notice when reviewing the table. Hey guys, just wanted to pull up a amortization schedule here so we could go over it, and so you can kind of see the official document, what it looks like, and go over each of the different columns and sections of this document. So as you can see, it'll have the loan amount here. You're gonna have your term, 30 years, interest rate, 3%, and then you're gonna have your payment all the way from 1, and then you will have all the way down to 360 should be your final payment. So you have a 360 month, and you look at the date here, it gets kind of crazy to think about how far out, but nobody ever goes this far. Usually you're going to term down to a 20, 15, 10 year, to where you're going to be paying more principal and having a much lower interest rate whenever you do term that down. And so let's go back up here and take a look at a few things. One thing you're going to notice is, for the most part, on a 30-year mortgage, your payment stays the same. Now, you're going to notice on this one that the payment changes a little bit. And the reason for that is over here in the private mortgage insurance section. So your private mortgage insurance is changing because it's based on a percentage of your outstanding balance. And so it'll constantly be changing, okay? But without the mortgage insurance, which we'll go through later in the amortization schedule, your payment will not change. Your principal portion and your interest portion, if you add these together, these amounts will never change. You're just going to be paying more towards your principal as you go along and less towards your interest. If you notice, this first interest payment here is going to be your highest one you ever pay. Your first principal portion of your payment here will be the lowest you'll ever pay. This will continue to go up as you go. This will continue to go down, and your balance will continue to decrease. And so this is what I mean. You're only getting charged interest on the outstanding balance. You don't get charged for the full amount interest every time. This is your private mortgage insurance section. It's based on the remaining balance, so it continues to go down. This is keeps track of your loan to value. The loan to value that you want to go through is 80, and we'll take a look at that here. Because once you get to 80, you no longer pay mortgage insurance. Now, notice on this, you notice that the mortgage insurance doesn't go away at 80. And why is that? That is because when your mortgage insurance, when your loan to value goes to 80, the lender does not automatically drop your mortgage insurance off. You have to call and request it. However, once you get under 78% loan to value, the lender will take your mortgage insurance off. So once you get to this point, this payment here, well, look, that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. That's almost a year's worth of payments that you'll be making on mortgage insurance for just not paying attention and not being aware that you can drop it off once you get under 80. So just be aware of that. A good lender, a good loan officer is going to keep you in the loop and keep track of that for you and let you know when you can drop that mortgage insurance off. So just a little tip there for you. But let's take a look after mortgage insurance, because I want to demonstrate something for you here. So after we get done with the mortgage insurance here, let's go down. You're going to see that this payment doesn't change the remainder. The payment never changes. However, the amount paid to principal and the amount paid to interest is constantly changing. This is good when this goes up, and this is good when this goes down. This means more money is going towards your equity, your piggy bank. So this is what you want to go for. So after mortgage insurance, the payment's going to stay the same. While you have mortgage insurance, it's going to be kind of all over the place. So that is a amortization schedule. It's quite daunting if you look at it, but hopefully you understand it a little bit better. And if you see at the end, you're making almost all principal payment, no interest payment, same payment the whole time, and your balance is down to 0, and your LTV is down to 0. So this lays it all out for you, every payment you will make on this loan if you were to take it from day 1 to day 10,000 something. That's what it is. It's 10,000 something, but it's 30 years later. So hope this helped you, and reach out if you have any questions. Leave a comment below and I'll be happy to help. So let's just cover some of the easy basics when it comes to your amortization schedule. This word, amortization, took me forever to learn. For some reason with my Kansas accent, it always throws me for a loop, kind of like the word dreary. I always want to say drury. Anyways, back to the agenda. So the thing to remember and what makes this whole thing easy to visualize is this. During the course of your loan term, if you have a fixed mortgage, the total combined principal and interest portion of your payment will never change. The amount will stay the same from day 1 all the way to 30 years later. With that said, you are only charged interest on the outstanding portion of your loan balance. This makes for a payment breakdown between principal and interest that has the principal increasing every month and the interest decreasing every month. Now on a 30-year term, it's usually only about $1 a month, but after a bit of time it does add up. So the formula to figure out the interest portion of your home loan is this. You take the total outstanding balance and times this amount by your mortgage interest rate %. You then take the sum of this figure and divide it by 12. This will tell you your interest portion of your payment. To find out your principal portion, you simply need to minus the interest portion you found previously from the total principal and interest payment amount. The remainder will be your principal portion of your payment. So as promised, 3 amazing loan hacks that will help you reduce your payment down to the absolute lowest amount possible. The first hack is to understand the fact that every lender is going to have different mortgage insurance premiums depending on the third-party insurer they work with. It's always best to shop around for the lowest mortgage insurance, as this can have an even larger effect on your monthly payment than even the interest rate. The second loan hack is to also shop around for the lowest quote for the best coverage on homeowners insurance. I recommend using a broker, as they will be able to shop around to several different companies and make them compete, much like what I'm able to do with home loans. The third and final loan hack when it comes to saving on your monthly payment is to never allow the county appraiser to come into your home or onto your property and do an appraisal if they ever ask. Just tell them you haven't made any updates, everything's the same, and you don't have any time for them to come in and look around your property. Then when the property taxes are raised, as they typically are every year, you must dispute the increase. You have a set window of days you are able to do this, so stay aware of those dates and always dispute. Now, one final note here, if your payment goes up, it is 9 out of 10 times a result of your homeowner's insurance going up or your property taxes going up. One of the two. In either case, you need to contact your loan officer to discuss your options. So I hope you enjoyed these hidden gems and that they end up saving you some money on your monthly mortgage payment. So there you have it, everything you need to know about your mortgage payment, along with 3 amazing loan hacks that will help keep your monthly mortgage payment lower than Jeff Bezos' tax bill. Please leave a comment below if I missed anything or you have a question. I'd love to hear from you. And listen, if you gained value or knowledge from this video, do me a huge favor and smash that like button so more people just like you can see this info. And if you liked this video, I'd like to invite you to watch one of my other videos. Over here, I explain and hack every major home loan product. And over here, YouTube has determined that you may enjoy this video. Thank you for tuning in. Until next time, best of luck.